Now, the part of the show that I believe individual investors love to focus on, love to hear about. And this is the part where I talk about three things that individual investors need to focus on before you make your investment decisions over the next 5 to 10 business days. And as you can see, a lot of the three topics that we have up on our screen, we've had many times before. And it just seems like the same themes keep popping up week after week. And they're the themes that continue to control the way the market moves. And investors are keeping an eye on these things. And number one, Fed speak. We're hearing a lot about the Federal Reserve. We continue to hear the pressure that the President of the United States, President Trump, puts on the chairman of the Fed, Jerome Powell. It seems like every day he keeps talking about Jerome Powell and talking not too nicely. I think his latest was Too Late Jerome, I think is his nickname that he has for him, referring to the Federal Reserve being too late to cut interest rates. President of the United States, President Trump believes that the Fed should have cut interest rates already, and he's hoping for as much as a 3% decrease. So Fed speak, we're hearing a bunch of Fed governors speaking out over the last little while. We're going to touch on that. Trade and tariffs. What's the latest on trade and tariffs? We're hearing more and more that we're getting these sectoral tariffs, and we're hearing more and more about trade between the U.S. and other countries that have already made a trade deal. Countries like ours, Canada, which has yet to make a trade deal. And obviously trade between the United States and China is obviously a hot topic. And a bunch of tariffs that the U.S. is threatening to put on places like India and China if they continue to purchase energy or oil from places like Iran and Russia. So we're going to touch on trade and tariffs and corporate earnings update. We continue to get earnings one after the next. Corporations report how well they've done the second quarter of 2025. We're going to talk about a few different types of names in different sectors and how they've fared. But again, you want to have definitely one eye on corporate earnings and how these companies are faring. So let's move on to our first topic, and that is Fed speak. So we've been hearing a lot, obviously, about from the president putting down the head of the Federal Reserve. And lately, we've received information that during the last vote at the Fed meeting, they had actually two individuals dissent, not agree with what the conclusion was. And that conclusion, as many of you know now, was to hold interest rates as they are, keep interest rate increases on hold or pausing, if you will. But two governors decided to go against the crowd or the group, and they've come out, a couple of them have come out and have said that they believe the Fed actually should be cutting rates already. We have a quote from both of those Fed governors. We can put the first quote up on our screen. There it is. And this is from Michelle Bowman. She is the one of the governors, one of the Federal Reserve governors. And what she said recently is, with tariff-related price increases likely representing a one-time effect, and I'm going to touch on this idea of tariffs being a one-time effect because, yes, it may be true, but I don't buy it. I believe that tariffs actually increase prices, and those prices stay elevated for forever. Very rarely do you see inflation or prices drop once they've been increased. But what she says is that they're likely representing a one-time effect. It is appropriate to look through temporarily elevated inflation readings. I see the risk that a delay in action could result in the deterioration in the labor market and a further slowing in the economic growth. So Michelle Bowman believes that we're seeing a slowdown in the U.S. And, I know that President Trump would love to see a cut in interest rates, but I think for different reasons. Michelle Bowman wants to make a cut in rates because she thinks that the U.S. is slowing down, that we need to see interest rate cuts to help stimulate a slowing economy. Our second quote that we have is from Christopher Waller, another Fed Reserve governor. And what he says is there is nothing wrong about having different views about how to interpret incoming data and using different economic arguments to predict how tariffs will impact the economy. But I believe that the wait and see approach is overly cautious and, in my opinion, does not properly balance the risk to the outlook and could lead to policy policy falling behind the curve. And what he is saying is that if the economy falls too quickly, the Fed could be behind the curve or wait too long before cutting rates to stimulate, and that it would be a big issue and problem for the economy. So that's what the two Federal Reserve governors that I guess disagreed with the pause in interest rates, but that's what they were saying. And again, it's as I was saying in my previous segment about a slowing US economy, it just depends on what you are looking at. You can look at the glass as half empty or half full. I think these two Federal Reserve governors are looking at it more as closer to empty than full, whereas the head of the Fed, Jerome Powell, is saying there still isn't enough information or reason to cut interest rates. We'll see over the coming days and weeks if more Fed governors speak out, in terms of whether they believe the Fed should be cutting rates next meeting in September. With the recent data that has come out with respect to jobs growth, now the chances of a rate cut in the U.S. for the month of September is now up to 80% once again. It was 80%. And then when we saw some strong economic data, GDP, retail sales, it dropped back down to below 50%. And now it's back up to about 80% once again. Our first chart here shows the U.S. unemployment rate. And you can see here, 4.2%. It has definitely moved up from about 3.5% back in 2023. So a slow grind higher, but 4.2% is pretty much full employment. And so when you look at this number, it's hard to argue for a interest rate cut. Why would you want to cut interest rates when you're seeing unemployment at 4.2% or pretty much full employment? Yes, unemployment is moving higher, but still nowhere near high enough, in my opinion, to justify the Fed cutting rates. Our next chart here shows retail sales. And we actually had this chart, I believe, on our last show. And you can see here in June, retail sales were very strong, up 0.6%, a great rebound or a nice rebound from May. And on the right-hand side of our chart here as well, percent change in retail and food services sales from the previous month. You can see a huge rebound in the month of June. So again, focusing on retail sales, focusing on the unemployment rate, focusing on GDP, focusing on inflation creeping towards 3%. All reasons why I believe the Fed should be, standing pat. I don't think we should see rate decreases. I don't think the Fed should cut rates. I know the President of the United States would love to see rate cuts so that the debt levels or the amount of debt or interest on the debt that the U.S. is paying will come down. The debt now, the interest they're paying over $1 trillion in the U.S., just an astonishing number for any country. But President wants to see rates come down. He believes that this is a great way to reduce interest that they'll have to pay. So unfortunately, the Fed doesn't look at it that way. That's not their mandate. Their mandate is full employment and stable prices. So we'll have to see if the pressure on the Federal Reserve gets to them and eventually they end up cutting rates. Our second topic, or I guess second topic out of the top three things to consider before you make your investment decisions, is the continuation of trade and tariffs. And our first chart actually shows exactly where we stand on tariffs today. And you can see here on the left-hand side, maybe we can make that just a tiny bit bigger, but on the left-hand side, you can see that the European right off the top, you can see where their tariffs were, which is the gray. There you go. Thank you for enlarging that. You can see that once upon a time, it was 30%. And with the recent trade deal, it dropped down to 15%. Moving down the ladder, you can see Canada. Canada is up to 35% on non-USMCA compliant goods. The good news is most of the goods that we ship down to the US is USMCA compliant. And I think that affords the Prime Minister time to make a good deal, not necessarily a quick deal, but a good deal for Canadians, because most of the things that we send to the US is USMCA compliant and therefore has no tariffs on it. But if you go down the list of countries, United Kingdom, 10%, Brazil is a big one. Brazil could be as much as 50%. I know they were talking about that. I know here it says 10%, but Brazil could be a lot larger. I know that the Swiss, 39%, trying to work out a deal. Hopefully that can happen before I believe it's an August 7th deadline. And then you just go down the list. So you can see here clearly that the tariff rates have gone up. And again, this is where I want to touch on this idea of inflation as a one-time effect or has a one-time effect. And I'll explain why the president and many economists and many of the Federal Reserve governors believe it's a one-time effect. Let's put up the definition of inflation, and you're going to see exactly why that is. Inflation. How does it work? Well, inflation represents the rate at which the cost of goods and services increase over a period of time. So it's the rate of change of prices, not about how much the prices go up, but by how much that rate of change is. So for example, prices can be, for something $100 and then it goes up to $105. So the rate of change is roughly 5%. And then the next time it could go up only by $1. So now the rate of change is something even less than 1%. But you're still now at $106 for an item that once upon a time cost $100. So the inflation rate would show that it is coming down from, let's say, 5% to 1%. But in essence, it's the consumer that is now paying over 5% more for that item. And that inflation compounds over time. So yes, I agree that the inflation is a one-time event. You get a spike in prices perhaps because of the tariffs, but then shortly after that, prices won't go up anymore, right? They just go up that one time. But it's the people that continue to see the higher costs. And we're hearing from businesses all the time. We're hearing from businesses talking about how they're having to eat more of the costs, whether it's GM or Ford, telling us that they're spending hundreds of millions of dollars just to because of the tariffs to eat some of these higher costs. We're hearing retailers, whether it's Amazon, whether it's Costco, whether it's Target, all these companies are raising their prices right across the board and different areas of their business. So it's definitely starting to affect everybody. And all of those companies that were very good at shipping goods prior to the tariffs at the lower prices, they probably shipped 3 to 6 months worth of inventory. All that inventory has pretty much been sold or worked through, especially in the automobile sector. And now what we're left with are higher prices. Our next, I guess we'll call it illustration, talks, I think, really well about the rate of tariffs that the U.S. is seeing right now and state of U.S. tariffs as of July 2025. There you have it. And you can see here that the current tariff rate based on the Budget Lab, which talks about the current tariff rate, you can see it there. Consumers face an overall average effective tariff of 18.4%, the highest since 1933 for Americans. And it says after consumption shifts, the average tariff might go down a little bit to 17.5%. I can tell you, a year or two ago, that rate was probably 2-3%. So you can see how much prices have moved higher over the past, let's call it 7 months. And there is no end in sight. According to the Trump administration, there will always be a baseline tariff, whether it's 15%, 10%, and you couple that with some of the higher tariff rates on other countries, 20%, 30%, et cetera. That's how you get that 15 to 20% inflation rate for U.S. consumers. And I know the president just yesterday, I saw an interview on CNBC, and he talked about how much money he is taking in, or the U.S. is taking in. And I guess my question would be, at what cost? And to me, it's the cost to the consumer. And the president and his administration just doesn't see it that way. He believes it's at the cost of the exporting nation, that they're swallowing the costs I guess time will tell. Our third point that I want individual investors to consider before you make your investment decisions are corporate earnings. And we are pretty much, I would say, about two-thirds of the way through the corporate earnings season, especially in the US. In Canada, we started a little bit later. But I wanted to highlight a few stocks that have caught my eye in the past few days. Let's put up a chart of Palantir. Palantir, which has been one of the biggest benefactors of AI, artificial intelligence. I know a lot of people, if I ask you what has been the best performing stock as of late because of AI, for example, this year, a lot of people would say NVIDIA. And the actual answer is Palantir. Look at that chart of Palantir. It's done extremely well. A lot of government contracts incorporating artificial intelligence into their business model. Just a phenomenal stock. Very expensive. So all of you that are watching, no, I'm not recommending buying this stock necessarily. I think you have to do your homework and consult your investment advisor. If not, you can consult me. It is a stock that is very, very expensive and very volatile as well. Our next stock is one on AMD, Advanced Micro Devices. This is the second largest chip maker in the United States. Obviously, NVIDIA, $4 trillion company today, is the largest. AMD is a distant second. They just reported earnings yesterday. They came in and around expected. They didn't really do anything too extreme to get investors too excited, although the stock initially went up when they heard how they performed, went up a little bit. But AMD has had a tremendous run. Look how much the stock has gone up. I think it's gone up close to 45, 50% year to date. It's just been on a tear ever since it hit those lows back in April. So a name like AMD probably was a great opportunity. And now, again, getting close to around a 40 times earnings, 40 times forward earnings per share. When you start to see numbers that high, I think it's I don't want to say a red flag, but definitely you're probably not going to be looking to buy much at these prices. Another name that I wanted to bring up, and it's Caterpillar, a name that we talk about from time to time. Obviously, very important for construction. And you can see the chart here, a phenomenal run higher. They actually disappointed earnings. They came in below expectations a little bit, but not too much. And the market, as the market does lately, seemed to overlook it. And Caterpillar, again, initially was higher on the earnings. But yesterday, for example, we saw markets sell off a little bit over the afternoon as we started hearing some more information about tariffs and future tariffs and all that. And that kind of spooked the market a little bit. We also saw that negative, slightly negative services number, which took the market lower as well. Our second last chart, or third last chart, I should say, is one that I wanted to touch on because not often we see positive earnings with Pfizer. Pfizer came in with positive earnings. And actually, we saw positive earnings. I take that back. The last quarter as well, Pfizer took up expectations for the future. So they had a good day in the market once they reported earnings. Yesterday, before the market opened, stock was up throughout the day, over $24 a share again. But again, it's still well off where it used to trade into the low to mid 30s. Stock or shares still pay a fantastic dividend of in that high 6% range, 7% range. So a name that if you're looking for income, maybe you want to take a look at Pfizer. But for a while now, it's been, as you can see by the chart, we call that dead money. Unfortunately, the stock hasn't been much of a mover. Walt Disney reported earnings this morning, and this is a name that you can see here has had a good run, kind of plateaued in around 100 and let's call it $120 a share. A name that I think has a bright future, obviously with CEO Bob Iger coming back to the company. It's done wonders for the company. So a name like Disney, I think you could take a look at. And last but not least on our list of chart names and corporate earnings to take a look at is Eli Lilly. the largest U.S. largest pharmaceutical in the world, actually. I still believe this name becomes the first trillion-dollar pharmaceutical company. You can see how volatile the name has been. For those that don't know, Eli Lilly has the GLP-1 drugs, the weight loss drugs, Alzheimer's drugs, a tremendous pipeline of drugs, potential for a few blockbuster drugs there in the future. So it's not just putting all its eggs in the weight loss category. And I think it's a name that well off its highs, over $100 a share off its highs. I think it's a name that for some you could take a look at going forward. So corporate earnings season has been, I guess, in general in the US, fantastic. In Canada, maybe a little bit soft, at least to start. But corporate earnings in the US beating expectations. Most stocks over 80% beating expectations. And that is a good thing. And that is, again, another reason why we believe the economy in certain areas is still pretty strong. And probably another reason why the Federal Reserve isn't too quick to be cutting rates. So corporate earnings, again, is one of our three topics that I think individual investors should be focused on before you make your investment decisions.